Welcome to Rural Classroom Live, Albert. I'm Albert Liu. This is the online community for natural resource investors, and I'm joined, as I am always on Thursday, by Rick Rule, president, founder of Rule Investment Media. Rick, welcome to the show.
Pleasure to be back with you, Albert. Thank you for having me back.
It's our pleasure, Rick. We've had a busy week, a lot going on. There was the conference at Beaver Creek. I had Joe Mazumdar on yesterday. I had Brian London on before. I want to get your thoughts on sort of what's going on, sort of the new enthusiasm that's enveloped our industry. But before that, we've got lots of stuff in the market to talk about as well. We finally got our rate cut. Stocks seem to like it. Bond yields are up slightly, but gold has retraced a little bit. So your thoughts in general on what's going on in the market?
Well, you may recall, Albert, we talked a little bit about the impending rate cuts 4 or 5 weeks ago at the Rural Classroom. This was probably one of the most widely telegraphed trades in history. And I think the gold community in particular was way out front in this. It's worthy to note that the impact of the rate cut will occur over time. The market reaction, I think, occurred, at least with regards to the gold stocks, ahead of it. Uh, the second thing is that any discussion of the momentum in the gold stocks that has any hint of complaint, uh, let's just say that the gold stocks have done reasonably well over the last 12 months, Albert. And people who can find something to complain about, including the fact that perhaps they didn't respond after the fact with the rate cut when they responded so dramatically before the rate cut, probably need to examine the way they process and act on information. The gold stocks at really all levels have been serial outperformers this year. Uh, and that brings up a very interesting note. Earlier gold bull markets in my life have followed fairly predictable patterns. And we've talked about this a lot with the best of the best, the best of the rest, that sort of thing, running down the quality chain. Everything is running it right now, from the best of the best all the way through in movie parlance, the good, the bad, and the ugly. It may be because there are many more sources of information now through social media, something. I don't know what it is, but I'm interested to see that the normal bull market cycle that we see in commodity stocks and other stocks is being short circuited. Everything is happening in much, much, much quicker time. No comment here. It's just something that I've noted and something that's of interest.
Rick, I talked with Joe Mazumdar, I think it was yesterday, and he was just back from Colorado, and he started his talk by mentioning some of the maybe excess behaviors that he's observing now in the community, and these are not out of the ordinary for a bull market in any sector. So I'm not meaning this as a criticism of the mining sector in general, but
Right.
or in particular. But he said more deals. So he mentioned bought deals being offered to non-cash flowing companies. He said, the job market for analysts, I think, is looking up. He said, literally, the steaks at the finest steak shops had sold out by Thursday, Rick. And I just wanted to know from him, like, was he seeing anything that was truly alarming? Because people will spend money when there's more money to be spent. There's more marketing, there's more hiring, and so on and so forth. And he seemed to think that, he stopped looking for beta a long time ago, and now it's really the time to look for alpha. That's Joe with his newsletter. Rick, what are your thoughts on that in general?
I think I'm in exactly the opposite camp. I will need to say that I didn't go to Beaver Creek. I spent my time more profitably employed. I was being dragged around in a Jeep in Namibia, looking at lions and elephants and hippos, having a vacation with my wife. And I think I'm glad I did. I was talking to a very intelligent, high net worth retail investor who was at Beaver Creek. And he really sounded a note of caution. I talked to him this morning, and he said, there's a bunch of guys who you haven't seen around these conferences for 10 years, and you haven't seen them for good years, for good reasons, because they cost so many people so much money in past cycles. And he said all of the trolls, all of the scumballs have crawled out from beneath the manhole covers and the bridges that they've been under for the last decade, and they were all present at Beaver Creek, which is not a good sign. I'm not suggesting to you that this gold bull market is going to be derailed. It won't be, because the underpinnings for gold, I think, are extraordinarily strong. But we've come into the really dangerous part of the market. I've had a couple calls today where people are recycling old projects, one of which succeeded in the past, one of which failed in the past. But we're talking about pre-money market capitalizations that, had they been looking for money 2 years ago or 3 years ago, would have commanded at most $10 million pre-money, one of which has a pre-money of 75 million, the other of which has a pre-money of 95 million. we are in a very frothy, very, very, very dangerous market. As I say, the bull market is intact, but the circumstance exists now where separating the unwashed from their money uh, is really truly in bull market territory. People need to pay very good attention to what something is worth, not merely to the price. I need to say, Albert, for the last 5 or 6 weeks, I've been not a really, a reasonably aggressive seller of some of my more speculative names. I hadn't anticipated selling these stocks for a year or 18 months, but the prices that I had anticipated fetching in a year or 18 months are here today. To the extent that the price of something goes up fairly dramatically with no news to justify the price increase, I think the rational speculator is a seller, which is what I've been doing. Note, I'm too greedy to have sold all, but I have many circumstances really where stock that I bought 2 years ago or 18 months ago or 3 years ago, where the stock is up, 3, 4, 500%. And certainly you can understand in view of the gold price that by some estimates, the net present value is up substantially. But the truth is I've gotten too much performance in a very short period of time without enough news. And I've learned in past cycles, Albert, that no matter how much I like the people and no matter how much I like the asset, in the absence of news that confirms value, when you can sell, say, 30% of the stock that you own and take all of the capital out of the position, that is to say, when you can enter the point of no concern with 60 or 70 or 75% of your position by selling a piece of it, you're usually well advised to do that. I have not, for the most part, left the money in cash. Mostly, I have recycled the money back into market beta as opposed to market alpha, going to store the money in the best of the best names, putting the money back in the sector, but putting it in names like Agnico, Franco-Nevada, and Wheaton Precious, so that because I believe in the underlying strength of the bull market, I'm not out of the sector. What I'm doing is, as opposed to Joe chasing alpha, I'm storing money in beta, looking for new alpha opportunities.
That makes a lot of sense. Now with Joe, that is his value add in his company, so obviously that's why
Right.
he's doing it. Rick, in cases when you don't exit the entire position, this is a statement, I believe, on your behalf that you believe the name will grow into the valuation, right?
Uh,
And you want to stick around for the next phase.
Certainly. If we've talked before, Albert, you and I, in front of this audience about the fact that if the reason to own a stock goes away, the stock has to go away. In other words, if the news that you have anticipated comes back and it's bad, you sell the stock. You take no prisoners. You kill it. The positions I keep are ones where I believe there's a lot of exploration upside, or I believe that the answer to the unanswered question that the company is in the process of answering is positive. For people who don't understand the preceding statement, go to the Rural Classroom, an introduction to natural resource investing, and you'll hear all about the process of answering unanswered questions, where I believe that 12 months from now, the answer to the question that I am asking will be answered, and it will be answered affirmatively. I continue to hold the stock. But there are circumstances now, Albert, I'm seeing where the price appreciation that I had anticipated getting with a yes answer to an unanswered question has come even before the question has been answered. If you think that the stock can go from $1 to $2 if XYZ happens, XYZ hasn't happened yet, but the stock goes from $1 to $2 anyway. In the absence of confirmatory news, I have learned in prior bull markets that one is best advised to take at least some of the money. I understand that a yes answer is worth more at $3,600 gold than it was at $3,000 gold. That notwithstanding, in a market like this, where there's too many dollars chasing too few goods, it's wise to supply some goods. Uh, Anybody who went to Beaver Creek points out the numbers of deals that were getting done. This is not necessarily a positive, Albert. When a company issues stock in exchange for cash, what they're saying is that their shares are worth less than the cash that they're receiving. They are sellers. If the management team owns 5% of a company and they do a financing which they don't participate in, they are diluting themselves. Now, there are reasons to do a financing. If you believe that the money that you can raise by selling, say, 10% of the company can allow you to use the money and increase dramatically the value of the remaining shares, that's a positive use of proceeds. All I'm trying to say is that this rash of financings that's occurring presents certain risks, and investors need to keep in mind that companies who are raising cash believing that the cash that they raise is worth more than the shares that they are selling. Buyer beware.
Okay. And then the fact that you are rotating but back into the majors suggests that your belief that the irrational exuberance is not on the side of $3,700 gold, but more on the side of these junior speculative names.
Absolutely correct. Remember that many of the juniors presenting at Beaver Creek, technically speaking, have no gold. They're looking for it. If the price of something that you have none of goes up, it wouldn't rationally impact your values, only your price.
Okay. So before we got on the show, Rick, we were talking about sort of the efficiencies of the market. Uh, in this case, at issuing paper, at debasing paper, government is not the only entity that can do this, Rick. And you're going to see it in this sector, and among issuing companies. That's kind of a normal thing. What are your comments on that, though, as to the efficiencies of it?
We'll get a lot of hate, Albert, which I guess we deserve. A lot of us in the gold business point to the fact that the government, uh, you know, cranks up the printing press and generates all kinds of phony baloney paper. You and I have discussed before, Albert, that the private sector is always better and more efficient than the public sector, even when it comes to printing up phony baloney paper. We're seeing lots of share capital get issued in exchange for money. The difference between printing phony dollars and phony share certificates is only that the government can use the guns to force you to buy the phony baloney dollars. But these promoters are pretty efficient
That's a big difference, by the way, Rick.
it is in fact a big difference. I'd prefer to make my own mistakes as opposed to have my elected officials make my mistakes for me. I've
Yeah.
had plenty of experience with both, Albert. But I would caution people to substitute being a victim of one type of inflation for being the victim of a different type of inflation, however voluntary that process might be.
Yeah.
I would urge people who find this bull market to be a cause for optimism to consider their feelings 3 years ago when these stocks were cheap and examine why it is that they were unwilling to buy the stocks when they're cheap and why it is that they're willing to pay so much more today. And I would ask people who are listening to this to revisit the lessons learned in Introduction to Natural Resource Investing at the Rural Classroom, because the price of something has no relevance if you don't have an opinion as to value. And there are some tried and true methods to measure, however inefficiently, value. The idea isn't that you will ever get it right. You never will. The idea is that you get it more right than you otherwise would have, and more right than your competition does. And I would again urge people to look to the Rural Classroom and Introduction to Natural Resource Investing, because bull markets are frankly much more dangerous than bear markets. They're more fun, they're more exhilarating, all that kind of stuff, but they're much, much, much more dangerous. The time to be really investing wildly or speculating wildly in natural resources was back around the time of the formation of the rural classroom, however long ago that was, utilizing the lessons that we taught then. By the way, on if nothing else, the people who sponsored the various boot camps would have yielded very, very, very handsome returns with much more risk than is present in the market today.
Okay. I covered a lot of news items with Joe and Brian over the last 2 days. I'm wondering if you're interested in commenting on any of these. One that came up was the deal with EMX, Rick. Your thoughts on sort of the outlook for on both sides, for investors on both sides?
Well, I think it's potentially a very good transaction. I hope it is a merger in the truest sense. The value add in EMX has always been their technical acumen and their ability to generate royalties with their own geological expertise, and their ability, as a consequence of that, to find transactions to buy that weren't broadly in the market. The fact that Elemental now has a real sugar daddy, which is to say Tether, with access to more money than God, uh, points to something very, very attractive. My hope is that there are holders of both companies who will be disappointed in the merger and will sell it because they were holding the stocks in anticipation of a transaction. And I hope that the resulting company sells off, as is often the case in mergers. To the extent that that happens, I'm likely to be a pretty aggressive buyer. We have talked before, Albert, many times in the Rural Classroom about some of the virtues of M&A. One is simply that a larger entity generally has greater trading volume and is included in more passive indexes. Higher share prices equal lower cost of capital. This is a capital-intensive business. There are other advantages too. A carefully constructed merger removes overhead, which is to say that the general and administrative expense relative to assets under management or relative to free cash flow goes down, which is good. A third advantage is that the company's investment allocation decisions are spread over a larger number of assets, which gives management teams, disciplined management teams, the ability to generate higher returns on capital employed. So ideally, this will be a merger as opposed to a takeover. And ideally, shareholders of the combined entity will do better in this circumstance than they would have individually. Conceptually, this is a wonderful merger.
One thing that came up in our discussion was that Joe really liked the prospect generation aspect of EMX and how it generated its own royalty opportunities. We saw the same thing with Origin, and whereas Elemental, I guess, was more of an acquisition mode. How do you expect the combined entity to, like, philosophically, what will the combined entity be?
That will be up to Tether, I think. I hope that Tether recognizes that the EMX model has two advantages. It lowers the cost of royalty acquisition by creating royalties, but it also allows a lot more thorough due diligence in the acquisition market and access to royalty and streaming deals that are off market. So I certainly hope that the EMX team stays intact. Elemental offers probably better financial acumen, that is, financial services or capital markets acumen, because I think that the EMX guys have a lot of commercial acumen. And as I say, the merger of the two presents an extremely attractive proposition if people keep both parts of the business intact. One will note that EMX has had higher than industry average general and administrative expense because prospect generation is a capital intensive, which is to say a front end capital intensive business. If you look at EMX over 10 years, however, and you back out the merchant banking profits that they've enjoyed, not the royalty and streaming profits, but the merchant banking profits that they've enjoyed as a consequence of that high G&A, their G&A bill all of a sudden goes to zero. you, you have to look across time at the whole enterprise. And my hope is that that continues.
Okay. One thing about this deal, and then also the involvement of Tether, Rick, is this a case where these resource assets somehow are more valuable on the balance sheet of a company that issues stablecoins than they would be somewhere else?
I don't believe so, but I do believe that Tether has access to capital and access to capital pools and investors, which adds new legitimacy and luster to the junior royalty space and the project generation business. I take at sort of face value the idea that Tether believes that generating gold through royalties and streams is a superior acquisition strategy for them rather than simply buying it in the market. I get that. I get the fact that they believe that the prospect generation royalty business means that they ultimately become $1,500 gold acquirers as opposed to $3,700 gold acquirers. That only holds true if they operate the business well over time.
Right. And if you are one of those shareholders, and I'm asking Rick, not because I think or know that you're a shareholder, but you have contacts within Silicon Valley, and this is kind of new and strange behavior for them. So do you have any insights on what they're thinking? Are they happy? If you're a shareholder of Tether, are you happy that that's how they're spending your money?
I don't think that. I don't think that the Tether shareholders know or care about this transaction relative to Tether. Relative to the fact that they have become larger than Fidelity from a standing start in 10 years. This transaction is not even a pimple on a blue whale. It doesn't matter. For resource investors, this is entirely different. Our mutual friend, Paul Stevens, who, as you know, is a very seasoned tech investor, has been championing an Elemental EMX merger for a very, very long time. And I would suspect that Paul is ecstatic as opposed to merely happy. Paul understands the value add in prospect generation. He understands that exploration really is a technology business, not an asset-based business. And he has always liked the capital pool. The London and later Cairo-based investors who were behind Elemental strike Paul as being extremely savvy resource entrepreneurs and financiers. And from Paul's point of view, even ex-Tether, this was an ideal merger. And Paul's a very sophisticated, well, initially an extremely sophisticated technology investor, and later an extremely successful and sophisticated natural resource investor. I hope that answers the question. I think from the Tether shareholders' viewpoint, this is a floating irrelevancy. From the point of the resource business, at least the junior resource business, this could be a very important transaction. This could unlock access to very different and very smart investors who could benefit our whole process.
Okay, let's move to sort of the bigger fish. Newmont came up in our discussions, and Joe was pointing out how they are trying to get leaner from a head count point of view, as well as they've been spinning off assets that don't fit into their strategic roadmap. And the reason he gave was they want to get leaner. They want to compete with Agnico that has a lower all-in sustaining cost. They're going to do that with headcount, Rick. Among other things, what are your thoughts on what's been going on, and also the benefit to the companies that have been the acquirers of these spin out assets? From what I understand, they've been acquired at very reasonable prices.
Reasonable prices. I think that's right. Not cheap, but reasonable prices. And a few comments there. The first is, and we've covered this ground in the Rural Classroom in the past, but for those listeners today who weren't in those past sessions, I'll recount them. Newmont grew by acquisition, and they acquired lots and lots of mines. Some good, some germane, some not so good and not germane. After their acquisition of Newcrest, which ironically many years ago they spun out, they made a pledge to investors that they would sell off all of their tier 2 assets and only focus on tier 1 assets. The idea being that in terms of both sustaining capital, but also management time and attention, that the company's focus was being diverted to too many small assets that didn't matter to Newmont. And Newmont made the decision, rightly, I believe, to sell off a whole range of assets that almost no matter what they did on an individual basis wouldn't make a difference to Newmont. They set out to raise $2.2 billion from selling these assets. At last count, they'd raised about 4.5 or 4.6 with some contingent payments to follow. Freeing Newmont from having to make sustaining capital investments on 10 or 15 mines, which they sold, but also allowing them to focus management time and attention on really large, really germane projects, while at the same time really, really cleaning up the Newmont balance sheet, has put Newmont in pretty good condition. They needed to reduce their headcount. I remember walking through the Newmont headquarters in Denver, sort of wondering, so what do all of these people actually do for a living? Because they have a lot of folks there. The fact that they were able to sell off all of these assets frees a lot of management time and attention, which means that they free a lot of management capabilities. Remember that anything that cuts general and administrative expense relative to assets under management or relative to free cash flow is a very, very, very good thing. Newmont may also be saying that, and I don't know that this is true, that they are better off, given their time and given their size, overpaying for very, very, very large, high quality assets owned by the juniors, 5 or 10 million ounce deposits, than they are in the exploration business themselves. I think it's arguable that Newmont has become a financial rather than an exploration culture. I don't know that to be true. But I noted, Albert, in our interview here at the Rural Classroom on behalf of Rural Investment Media, our interview with Amar Al-Jundi, who is the CEO of Agnico Eagle, that he was able very narrowly to define what Agnico Eagle is. He said that they are allocators of capital who focus on growing free cash flow per share and net asset value per share. He described their core competency as being a construction company, that they see themselves as being very, very good mine builders. And he also said that he isn't interested in just any big mine. He is interested in mines that offer real synergy with existing mines operated by Agnico Eagle. So in addition to getting leverage on the new acquisition, that they get leverage on existing assets, which can enjoy greater utilization rate with these acquisitions. It's precisely this type of focus that the gold industry as a whole, but Newmont in particular, needs to pay attention to.
Thanks for that, Rick. Great answer. And regarding, the concise and very precise vision for your company, I find that the people who are really masters of running these large organizations, they do that very well. And I'm also thinking of Jeff Bezos, with him, it always came back to obsessed with the customer experience. Everything they did could be boiled down to that, obsessed with the customer experience. And that makes it really easy for the layers of management, which you need in companies that are that big, to be on point with what the CEO has set for the direction of the company. So that was a great interview you did back in Boca. If anyone's wondering when that was at the annual symposium in Boca Raton. Rick, I want to get to some of the questions. First one comes from Alan B. He's interested if you've been able to raise your ranking on Marimaca Copper.
I have not. The particular reason for that is that my work was interrupted by a 13-day vacation. Botswana, something which I will not apologize for.
Okay, so that will be coming. Another question. Rick, thank you for reprimanding the classroom for not paying attention to the Tier 1 bootcamp news flow the other day. What other than your caution against bull market froth should we keep in mind?
Simply that value matters. There is a process by which one becomes a better investor. What happens, in particular in a market like this, where you make money on your mistakes, is that you say, oh, this is a good sector. I know this sector. I understand this sector. I'm making money in this sector. And you unlearn all the lessons that you should have learned 5 years ago. Most of the people who are listening to this discussion, Albert, are listening slavishly, hoping that I will give somebody a stock tip. And that stock tip is almost valueless. The circumstance that exists today that makes something in my mind a buy may disappear 6 weeks from now. Equipping yourself to develop the attitudes and the skill sets necessary to, in movie parlance, know when to hold them and know when to fold them, is much more important than any individual names which I or you or anybody else might proffer in an interview like this. That's why in these discussions, Albert, I refer people again and again and again to the lessons, which are the most important feature of the Rural Classroom. By the way, I'm delighted. I was sitting in Namibia, looking through the discussion group at the Rural Classroom, looking at the students in the Rural Classroom, employing the methods that we had taught, talking about individual companies, not saying, well, it's going to go up because gold is up, but rather doing some of the parts calculations. There's a good group here at the Rural Classroom who are getting it and who are doing the work. It's important that the rest of our viewers join them.
Yeah, please do. If you're joining us from YouTube or from X, we do this every Thursday, and we take questions primarily from the Rural Classroom, although I will try to get some of your questions from YouTube and X today. But we also have a full course, Intro to Natural Resource Investing. And Rick often refers back to those when questions come up, because those questions have indeed been covered in detail at Rural Classroom. Rick, someone on YouTube is mentioning a global shortage of TNT. Is this true? Can you confirm this? And is this going to affect mining?
I can't confirm that it's true or not true. Explosives are obviously an integral part of the mining business. If there are shortages, believe me, markets work. I believe. I remember in the last bull market, we had a shortage of large tires, the type of tires that go around haul trucks. It took 18 or 19 months for that shortage to be eliminated, but we eliminated it. We can eliminate a TNT shortage much more quickly than we can eliminate a tire shortage. TNT is something, Albert, that if you and I put our minds to, we could make. A truck tire is not the same. So if there is a shortage, it will be eliminated. It could be a problem for 6 months, but not a problem that will bother us over time.
Right. So long as prices are allowed to fluctuate, right?
Correct.
Okay, let's see. You keep rightly educating about counter-cyclicality, going to places that feel uncomfortable, but you also called out your past mistake on the Living Legends panel that you are often too early. So can you please frame that in today's context? And where are you looking to go next?
I'd rather be too early than too late, Albert. I was talking on the Living Legends panel when I was asking other people to talk about their mistakes, about my own. I'm a cheapskate. I'm not as good about paying up when circumstances change. And I like things that are hated precisely because they're hated. And I need to pay more attention, perhaps, to valuation discussions. I also pointed out the fact that I'm very willing to accept political risk, and sometimes I'm too willing to accept political risk. An example would be Mali and Burkina Faso, both of which made me a lot of money, and then both of which cost me some. But the granddaddy of those lessons, of course, Albert, was Russia. I was an investor in Russia for very, very, very long time. And the country treated me extremely well, ludicrously well, until it didn't. And I pointed that out precisely because some of the mistakes that I made in the past were likely responsible for my success. Which is to say that while I experienced a real wipeout in my Russian investments, the truth is that my first experience in Russia, first big experience, a combination of Rosneft, Gazprom, and in particular Vostok Nafta, was a 100-bagger. I took way, way, way more money out of Russia than I lost in Russia. The loss was a recent memory and is useful for instructive purposes. But the truth is that I have courted political risk for 40 years. And while I have suffered losses as a consequence of that, I have made a lot more than I have lost. Similarly, with regards to being early, I was a fairly aggressive investor in the junior resource space, as people listening to this interview, at least as many of them know. And it's arguable that the investments that I made in the sector in 2000 and 2001 and 2002, frankly, had high opportunity costs. Similarly, the junior stocks that I've been selling in the last 4 or 5 weeks are almost certain to increase in price, which is to say I bought too early and likely, for some people, I sold too early. I notice, however, that being Rick Rule, 72 years of age, and taking great big fat slugs out of the middle, buying too early, yes, and selling too early, yes, but making money more often than not has served me very well over time. So the mistakes that I describe are partly self-deprecating humor, making fun of myself before somebody else does, but also a recognition that those faults are my strengths.
All right, fair enough. Um, let's see. Stefanos has a question. He wants me to ask you if you know anything about antimony and the current stimulus evolving in projects people are trying to get off the ground, like Nova Minerals in Alaska.
I think what you need to do when you're looking at antimony, first of all, is acknowledge that that market's extremely thin. We haven't explored for antimony because it's been too cheap. If we start allocating money to exploring for antimony, we're almost certain to find some. And if we find a high quality antimony market, pardon me, a high quality antimony project, that will likely take care of the supply shortages that are perceived in the market today. This is an extremely thin market. It's important, if you decide to participate in this market, that you limit your participation to companies that are at least strong tier 2 deposits. I would describe a tier 2 deposit as a deposit with at least $2.5 billion worth of in situ recoverable reserves and resources at today's antimony prices. But I would also ask you to focus on companies who, at least prospectively, would be in the bottom cost quartile worldwide. in terms of all-in sustaining costs around antimony, and also in the best quartile worldwide in terms of return on capital employed, but at any rate, ROCEs higher than 25%. I wouldn't suggest that people look at the antimony story and use that as an excuse to buy an antimony deposit that had failed in 2 prior market cycles.
Rick, this is a funny question. Coming in from YouTube, Rick should be every high school economics teacher. Now, I know you're going to disclaim that you are not an economics or an economist, but would you ever consider teaching in high school about business, for example, or resources or something else?
I have enjoyed, Albert, as you may recall, the opportunity to mentor many young people in subjects including economics. My favorite group, sadly, I no longer am able to mentor them, was a young group of African American, mostly ex-offenders. I say mostly because that community had a fair number of current offenders too. But it was very useful, probably more useful to me than a regular economics class in high school where the kids had to be there or they would get suspended. These kids didn't have to be there. They wanted to be there. Now, it's interesting that I had perhaps more freedom than a normal economics professor or teacher would. I was able to discuss economics in the context, as an example, of the cocaine trade, using examples that made sense to the kids, but probably wouldn't have endeared me to the principal. So the process of education I like. I don't think that I would do well in an environment like a high school, where I was constrained as to what I could teach and how to teach it. I certainly wouldn't want to exist on a high school teacher's salary, although I mentored these young ex-offenders for free. But I enjoy the process of education. I would tell somebody who thinks that my message might have value in economics that they could replace me extremely easily. What they should do is take the young person who they think might benefit from my teaching and buy them a copy of Economics in One Lesson by Hazlitt. And then make them read it. It's not enough that you give them the damn book. They have to read the book. But I suspect that a youngster who read Hazlitt would learn 60 or 65% of what I could teach fairly simply. Much more importantly, if that young student read Hazlitt before he or she went to university, it would save them the confusion that would occur when they went to university and they were taught this pablum that passes as economics. I'm sorry to harp on this, Albert, but it reminds me painfully of my first year of university when I took Introduction to Economics, which was a prerequisite to a commerce degree. And I was taught from this primer, I forget what it was called, but the Samuelson book, the classic first year economics book. And I remember in 1970 reading this, and there was, if nothing else, cognitive discipline. Cognitive dissonance. The celebration of centrally planned economies, the celebration of Keynesianism, the idea that spending was better for the economy than savings. This made no sense to me as an 18-year-old, but I didn't have the self-confidence or frankly, the education to say this is bullshit. A youngster who had read Economics in One Lesson, by the way, I didn't take an economics class after that for the rest of my university career. It turned me off economics completely.
And it just got worse, Rick. It would have just gotten worse.
The youngster who had read Economics in One Lesson by Hazlitt and then was confronted with the first year economics test from Samuelson would probably have been well educated enough to say, this is bullshit. I have to read it. When the test comes, I have to regurgitate it. But there's no requirement that I believe it. And that would have been useful for me at the same age.
Yeah, I mean, it would have turned you off education, though, even faster than just going through without knowing. Having confirmed yourself that it's not just worthless information, but harmful information would have really soured you on it. I actually had Matthew Smith and Doug Casey on the show as well earlier this week to talk about Doug's new book. And the whole topic of discussion was precisely that, college. and what you learn, whether it's worth it or not, is an interesting discussion.
Good for you. I think that their effort around that new book is a really, really, really good effort. I must say, I've not yet read the book, so I can't comment on it. I will say that I myself, at one point in time, when I was in university, uh, and I should give you a sidebar, I didn't attend university for any noble purpose, like increasing my worldliness or anything like that. I went there to get a piece of paper, which would enable me to make money. At the end of my third year in university, I learned that as a bar owner, I had to be a bar owner to put myself through school. I had to work at night so I could go to school during the day. I found myself at the end of third year making about 3 times as much money as my favorite tenured professor. That realization was the end of my university career. I found that university was getting in the way of my education. Uh, and so I'm probably more open to that discussion than many people would be. I'm not discouraging university attendance. I'm just encouraging people to look at the process of university in the context of their life goals.
Exactly. And both those interviews are at rulclassroom.com if you're interested. Let's go to another question here about uranium, Rick. How do uranium contracts evolve? And if we see similar contracts with rare earths, how this would be good or not good for a company like Meteoric. So he's talking about these term contracts, Rick. Is that what
Yeah,
we're talking about?
yeah. These term contracts are game changers. Some people don't like them because what they do is they cap the upside that a producer might enjoy from an increase in, say, uranium prices. I've said this many times in the classroom, Albert, but I'm an old guy now, 72 years of age. And you can take away some of my upside if you take away almost all of my downside. And that's what these contracts do. The contracts specify within a range the amount of material that a buyer will buy from the seller and at what price. Usually, these are reference prices, which means that the buyer will pay no less than X and no more than Y, Y being X plus an inflator or something like that. What it does is it allows the company to forecast with some certainty its revenues and with less certainty, but some certainty, its margins over time. That in turn, if the purchaser specified in the contract is an investment grade purchaser, that allows the company in question to enjoy a much lower cost of debt and equity capital, albeit it does cap the upside that the producer might enjoy from rising commodity prices. My hope is that this pricing model will be adopted in a variety of industries. And I think rare earths would be a classic one. Rare earths are one where the supply chain really doesn't exist outside of China, and financial markets don't really exist outside of China. The idea that a producer like Meteoric, as an example, could go to original equipment manufacturers, battery manufacturers, who need these materials for magnets, as an example, where the manufacturer, the fabricator, could lock in a guaranteed supply of the product at guaranteed prices, while at the same time, Meteoric could gain some certainty as to the price that they sold some amount of their material for, would benefit both sides. I think this has a lot of applicability to, in particular, producers and consumers of products in very thin, very volatile markets, like, as an example, the uranium market. Uh, this has existed in some way, shape, or form in the natural gas market, as an example, for many years. These aren't necessarily what you would term offtake contracts, but rather volumetric production payments, where natural gas producers sell a specified portion of their production in forward years at specified volumes and specified prices. The idea that you do this by way of, in effect, an offtake contract is something that I think has wide applicability in the mining business, particularly, as I say, around extraordinarily volatile commodities.
Okay. Is there any evidence of talks in this direction happening already? I saw, a really good interview with Jim Farley of Ford, CEO, talking about how this is becoming a real bottleneck for them, even shutting down production lines for short periods. Um, a natural partner for something like this, right? So, are there instances of
It's
this already underway?
it's funny that you say that. I have seen no evidence of it. I recall as long ago as 20 years ago, speaking to the head of procurement for Toyota in conjunction with the Japanese parastatal JOGMEC about the idea that major Japanese trading companies should sign offtake or production agreements 20 years ago. Another example, I guess, Albert, of me being early in this case, 2 decades.
Okay. Let's see. One of our friends, David Riley, asks for your latest thoughts on the ratings of Sol Gold and Greatland Gold, or Sol Gold.
Uh, I have Sol Gold and Greatland Gold, frankly, as fives. In the case of Greatland Gold, it's a soft five. In other words, I I need to see some news to reinforce me. In the case of Sol Gold, it's really all about political risk. That's a good deposit, but it's a huge deposit. And the upfront capital costs associated with that deposit will require political and social stability in the host country, Ecuador.
Here's a good question. I am reading There's Always Something to Do from Rick's mentor, Peter Kundal. Any lesson Rick learned from Mr. Kundal he could share?
Oh boy, Peter Kundal would be a whole interview, and perhaps we should do that sometime, Albert. Uh, I'm responsible for all of my mistakes, and he's responsible for all of my successes. Peter could well have said, there is always an asset class that's hated somewhere. Peter was a real believer that you can't be smarter than all of your competitors, so you have to be more disciplined. If there's a place where none of them are looking, you have to look there. And I guess that's shaped the way that I've invested ever since. Peter was also a huge believer in what were termed redundant assets, assets that were on the balance sheet that weren't contributing to the valuation. I remember that he had me early in my apprenticeship look at a company that owned a brewery in San Francisco and said, Rick, figure out what's attractive about this. I know a damn thing about breweries. Well, I mean, I did some due diligence at night, to be honest with you, so I had some familiarity with the brand in question. But in terms of the business aspect of the breweries, I didn't know anything. And the revenue line and the margin of this thing, I remember, looked like the electrocardiogram of a corpse. Just going sideways. Market share was slowly declining. It generated a fair bit of cash, which I understood. Cash being an attractive asset, but I didn't get what made it outstanding. And I was very, very conscious at that point in time of Buffett's criticism of the original dictum from Ben Graham of buying cigar butts. In other words, picking up something on the street that had 3 puffs left over because it was free. So I was concerned about that. And I remember I struggled with this and struggled with this and struggled with this. And, he kept saying, you need to look beneath the surface. Just keep looking. I'm not going to give you any hints. Just keep looking. Everything you said about the company is true, and none of it matters at all. And I suddenly learned, and I say suddenly, I should have learned this the first day, that the company owned its brewery. They owned the real estate. And the real estate, as I recall, occupied either a block or 2 in San Francisco. And it was carried on the company's books at its acquisition cost from, say, 1910. I didn't need an appraisal of the property to understand that the price had gone up of the price of that property had gone up an awful lot since 1910, and that likely the company in question could maintain their brand by having their beer made by a third party and simply distributing it under the brand, and in fact could monetize the property. That's what Peter Cundall taught me. I remember a similar lesson valuing timberland when he had me look at a company called Penobscot. Uh, Funny that I remember that, a place in northern Maine. And the truth is that similarly with Penobscot, the income statement wasn't stellar. They made money most years, but it was very, very volatile. What I came to understand, however, was that Penobscot owned a very, very, very large piece of fee simple timberland in northern Maine, including like something like 100 miles of water frontage on the Penobscot River. And the highest and best use of that riverfront was not producing low quality timber. I would say that's what I've learned. That's what I learned from Peter Cundall. Peter
Yeah.
Cundall introduced me to Marty Whitman. Pardon me, not to Marty Whitman physically, but rather to the works of Marty Whitman. And Marty Whitman talked about the difference between trough cycle earnings and peak cycle earnings. The idea being that in cyclical businesses like resources, when the companies had very high PE ratios, it was often because the E was depressed, and that often these companies were cheaper when they were selling at high PEs than when they were selling at low PEs, because you had to pay attention to what the relationship in the market was between the production cost and the ultimate selling price. And that was very useful to me. If you, as I did back in the 90s, looked at the copper business when they were valuing companies at the then prevailing price of copper, which was 75 cents a pound, versus the median all-in production cost, which is about $1.20 a pound. What you saw was an industry in liquidation where either the price had to go up or the world wasn't going to have any more copper. When you came to that realization, it was pretty simple. So I would say that the value investing lessons that I learned from Cundall, which were there's always something to do, is simply saying that there's always an asset class that's hated that you could have to yourself. There are often in old companies redundant assets, that is to say, assets on the balance sheet that don't contribute to current earnings. Longtime clients of mine, should there be any listening to this call, will remember back to the decade of the 90s when we started buying Canadian natural resource companies that had very, very, very large net operating costs, net operating losses, tax losses on their balance sheet. I remember one in particular, Canadian Natural Resources, which has subsequently become a huge success, that had something like $2 billion in net operating losses in a shell valuation of $50 million. So I learned from Peter Cundall to look at a balance sheet and an income statement by reading the notes first before I read the summary and conclusion. And I learned from Marty Whitman through Peter Cundall to understand the difference between peak and trough earnings, and to understand that companies are often expensive when they have low PEs and cheap when they have high PEs, because it's a function of E.
Very interesting, Rick. We are up against the time here, so we're going to have to cut it off here. I just want to mention quickly, our next Gold Boot Camp is coming up October 4th, Rick. This is the one people have been waiting for, because this is the one where we talk about speculative junior gold companies. It's part 3 of the Gold Boot Camp series. We've got your friend John Hathaway, Rick, friend and former colleague. We've got your friend Jonathan Goodman from Dundee. We have U.S. gold mining joining us. We have many other speakers, Adrian Day, Lobo. I'm looking forward to this because this is really what people want from you, Rick. October 4th. Any quick thoughts about it?
Well, it's unique that we have a product with a unique faculty at a point in time that's really, really, really timely. The faculty is amazing. John Hathaway, as an example, has been a dean among gold stock investors going back 45 years. If you look at the internet today, there's all kinds of recent gold experts who 3 years ago wouldn't have been able to spell it, despite the fact that it was a four-letter word. Jonathan Goodman is the second generation of an absolutely legendary mining family. His father, Ned Goodman, was one of my earliest and most important mentors. Jonathan, son of Ned, has served a 45-year apprenticeship. He's truly a spectacular investor. He's an honest human being. I would suggest that he and his team do perhaps the finest buy-side due diligence in Canada, which is going somewhere. Lobo Tigre, similarly, has served a 20-year apprenticeship. And he focuses on the junior sector. He's not a go anywhere, do anything guy like me in resources. He really focuses on the sub 250 million market cap side of the business. But like I say, he's been 25 years in the business. This is a really, really, really good faculty. It'll be interesting, I think, that I'm going to be the voice of caution here.
Maybe.
At the time when we conceived of this, which, well, really, we were urged by our listeners to do it 9 months ago. But when we really sort of conceived the boot camp series 2.5 years ago, these things were widely unloved and as a consequence, riskless. They are no longer riskless. So I would encourage anybody who is listening to this, who has a portfolio of developers and juniors, to pay particular attention to this boot camp. As always, remember, this is the only riskless transaction available to you. If for any reason whatsoever you don't think you got your money's worth, email Albert, not me, and you'll get your money back.
Yeah, that is a promise. Bootcamp.rulclassroom.com if you're interested. Rick, like I said, we've gone long today, so thank you for your time. Thanks for sticking around, and looking forward to next week.
Pleasure. I look forward to it too.
All right. Thank you, everyone, for your fine questions. We'll talk to you again soon.